Hello friends, welcome back to my channel Easy Accounting Hub. Make your study easy. This is Suni with you. This is my second video for ratio analysis, and in this class I will teach you how to calculate quick ratio. In my last video I have explained about current ratio. So current ratio and what is the ideal ratio for current ratio? What is the ideal ratio for current ratio? 2:1. So what will happen if your ratio is higher and what will happen if your ratio is lower? And in this class I will explain what is quick ratio. So what is quick ratio? Quick ratio also showing the liquidity and the ability of a firm to meet its short term obligations. Okay, so please listen carefully. Quick ratio or acid test ratio or liquid ratio. So this ratio is showing the ability of enterprise to meet its short term financial obligations. So quick ratio is showing the ability of enterprise to meet its short term financial obligation. Okay, so quick asset refers to current asset which can be converted into cash immediately. Immediately you can convert this current asset into cash. Those assets are quick assets. Okay, or it is either in the form of cash and cash equivalent, or it can be converted into cash within very short period, are the most liquid asset. Okay, so liquid asset or quick asset refers to current asset which can be converted into cash immediately. It comprises asset except inventories, prepaid expense and advance tax. Okay, which means we have to subtract from current asset these items. These items you have to subtract from current asset: inventories, prepaid expense and advance tax. Okay, quick ratio. Quick ratio equals quick asset divided by current liability. Quick asset, how to find quick asset? Quick asset is equal to current asset minus prepaid expense, inventories and advance tax. So we have to subtract current asset minus prepaid expense, inventories and advance tax. Ideal ratio for liquidity ratio. Ideal ratio for liquidity ratio is 1:1. So ideal ratio is 1:1. In case liquidity ratio is less than 1, okay, which means current liabilities are more than quick asset. Current liabilities are more than quick asset, which means a company is not in a position to meet its short term financial obligations because current liability, current payable is more than quick asset. Okay, so if it is high liquid ratio, which means understocking, and low liquid ratio is overstocking. Okay, so ideal ratio is 1:1. Okay, so liquidity ratio is less than 1. If it is less than 1, which means current liabilities are more and quick asset is less, then which means the company is not in a position to meet its short term financial obligations. High liquid ratio means understocking and low liquid ratio means overstocking. Okay, so let's do one question. Question: current asset, current liability. Current asset cash 5,000, debtors 29,000, bills receivable 5,000, marketable securities 15,000, inventories 54,000 and total also here. So total of current asset is 1,08,000. Then current liabilities: sundry creditors, bills payable, outstanding expense, provision for expense. So total also available here 54,000. So current ratio, first you have to calculate current ratio and also quick ratio we have to do. Then current ratio equation is current asset, total current asset divided by current liability. So total of current asset is 1,08,000 and that divided by current liability. See, 1,08,000 divided by current liabilities. See, if there is no total available, you have to add all these and take it as current asset, and add all these and take it as current liability. So, equation is current asset divided by current liability, then total current asset is 1,08,000 and current liability is 54,000. So, its ratio is 2:1. Okay. Next ratio is quick ratio. See, quick ratio equals quick asset divided by current liability. Quick asset means current asset minus inventory, then prepaid expense and advance tax. Okay. So, in this question, current asset includes only inventories. There is no prepaid expense and there is no advance tax. So, total current asset is 1,08,000 minus inventories. That will be your quick asset. So, quick asset divided by current liability will be the equation for quick ratio. So, 1,08,000 minus 54,000. That is 54,000, you will get 54,000 itself. Then 54,000 divided by total current liability also 54. So, 1:1. Ratio is 1:1. Okay. So, this is current ratio and quick ratio. Hope you all understood this class very well. I'll come with a new video in my next class, which is also from ratio analysis. If you like my class, please let me know your comments and please subscribe my channel. Thank you for watching.